Let's bring in Al Lord, who is zeroed in on the real estate market. He's the founder and CEO of Lexard Capital Management, joining us from the New York Stock Exchange. So, Al, it does seem like a lot of this market has sort of run out of steam somewhat. Are we just taking a break before the next wave? Are we waiting to figure out what the Fed does? Maybe not next week, but next month or the one after?
Definitely. I mean, all eyes are on the Fed. Unfortunately for the real estate market, the financing market is effectively shut. I mean, it's just having a profound effect. Transaction volumes are down over 50%. Commercial mortgage originations down over 50%. The small and regional lenders originations down over 70%. And everyone's just waiting for the market to stabilize and see what's going to happen. And you're talking earlier about the Fed dot plot. That, obviously that gives some kind of picture into what's going to happen in the coming year. But the elephant in the room is the $1.5 trillion of commercial debt that is maturing over the next 2 years, and how's that going to get refinanced? That's going to be a huge problem. It's going to have to get refinanced in much higher rates, with NOI mostly down. I mean, valuations are down, net operating income is trending down. This inflation world is hitting operating expenses. Insurance costs are way up. Property taxes are going up. It's a whirlwind of negative issues to deal with in the commercial real estate space.
Is the bargaining power on the tenants' side for the commercial real estate market? I mean, if you are a small business and you do want to have an office space, is it possible that some of the burden could be lessened on you if you negotiate well in a situation where a lot of vacancies are still lingering post-COVID? I mean, is there any positive spin there at all?
Well, there is positive spin if you're leasing, and if you're leasing an office space, for instance, or perhaps retail space. On the other hand, if you're trying to buy a home, as you were just talking about earlier, of where mortgage rates are and how difficult it is to get a mortgage, and with high prices to buy a house, it's hard. If you are renting, your rents continue to increase given inflation. And so it depends on what piece of the real estate market you're talking about, but there's certainly going to be room to negotiate commercial and retail leases as we move forward here.
When should we know the effects and the damage of this refinancing? Because now 6 months ago, roughly, when the regional banks were coming under stress, the main conversation about what shoe would fall next was commercial real estate. Yet, with this kind of lingering, elephant in the room, credit spreads haven't blown out. Market's been doing fine in stocks. Employment's been solid. I mean, is this like we're all looking at something, hoping we don't go over the cliff and it's inevitable, or has it gotten priced in?
Well, that's a great point. It is surprising because, the economy has held up here, and a big part of that has been unemployment. I mean, you still have 1.4 jobs available for every unemployed person, and so unemployment rate has stayed low, and that's part of the Fed's issue here with raising rates. So, absolutely, the shoe will drop on commercial real estate financing. And there is no doubt there is pain to come here. It's a question of how big it is and when it happens and what we can do. And a big part of that is what the Fed's going to do. How much longer will the Fed keep rates this high? When will they start easing, and when will the market start to stabilize? But there is more pain to come here. And it just depends on how big and when it comes.
How much of the blow could be softened by a push to return to office? It's kind of strange, to still talk about this as the post-COVID world, but frankly, our timeline has been scrunched a little bit, and it still feels like everything is very recent. Because I'm reading headlines like every other day about some big bank manager or various companies, even in the tech world too, they're saying, all right, our work from home abilities are capped. People need to start coming back in. Is there a way to do the math on kind of what the pre-COVID work from home rates were versus the big jump now and say, all right, if we go back to something closer to pre-COVID levels of in-office activity, could that soften the blow?
A little bit, but I think that landlords have the message. lessees, the companies that are leasing space have gotten much smarter, and they realize they can do with less real estate. They can cut costs by giving back some space. It obviously depends on when the lease expires, but people are working smarter. It will certainly help to have more people in the office, but getting a 5-day, 100% workforce in the office is long gone. So yes, and back to office is improving. The numbers are trending up, but it's still a long-term negative for the necessary space. And part of it's technology. We have a very efficient technology system, obviously, where you can zoom in and you don't need to be in the office. And with laptops and all the portable electronics, you don't need to be in the office. So a piece of that's never coming back.
Fair enough. Now, you guys generally focus on multifamily real estate. So if we kind of shift over to the residential side for a second, correct me if I'm wrong on that, but I know we've talked about that a lot in the past. How long can we keep this big gap between the potential stress of commercial real estate and the resilience of the residential market?
Well, it's a bifurcated market because in the long run, multifamily is going to continue to do extremely well. There's a shortage of housing. There just aren't enough apartments, and construction. There's a big number of units coming on this year and early next year, but that's going to level off. But we still are going to have a deficit. So that's certainly in the landlord's favor over the long run. However, the issues in multifamily are all about financing. So it depends on when your mortgage comes due. And given how low we had cap rates over the last couple of years, there are a number of buyers that purchase new properties that put floating rate debt on. And you could do it for as low as 2.01% on a floating basis, interest only, with no hedge. And that, as those maturities come due, that refinancing number is much, much different when you have, you have 10-year fixed rates where they are, and when you have a Fed that keeps raising rates. So it really depends on what kind of financing. If you have long-term financing, you're in great shape. Now, you were talking earlier with your earlier guest about the student loan payments, and yeah, that's certainly going to hurt people as they have to pay more make their student loan payments, and it's going to be harder to get a mortgage, and it's going to be harder to qualify. It's going to be less cash flow. So that's going to help the multifamily space by keeping people in apartments for longer and hurting the demand for housing. And the other piece of that is the housing equation, and you see with a 30-year mortgage around 7.25%, that's been up 40 basis points over the last couple of months. That just thwarts demand for new mortgages and for new house purchases. And then we've talked about this in the past. The supply of housing is just continues to be affected and limited, and you have maybe 3 months of housing supply of inventory. There's not enough inventory to go around. So it's really a difficult environment to operate in.
Really like the details here, Al. Very helpful for us to kind of separate where the strength is and where the weaknesses are and why each is the way it is. Good convo and good to catch up. Appreciate you joining.
Great to be with you again.
All right, thanks, Al Lord from Lexington Capital Management.